Hello friends, I'm back with another video. So in this video we will try to look at how we should progress in learning the stock market. Basically I want to teach you over a methodology so that you will become self-sustained and don't rely on any other news or any other uh, WhatsApp messages, whatever you get. You should be self-sustained. Okay, so basically we will try to understand what are the different investments, and then we will try to find uh, the right stock for us. So there are some parameters which I showed in my previous video, how we can look into that one, and then we will see how much profit we should make. It is not that in any stock that we purchase we can make 100% profit or 50% profit. So there should be some formula for that, and then we will also need to have a strategy for each of the investments or for the short term and long term that we do. And we will also do a stock shopping. Okay, and then we will try to automate that one. Okay, once we automate we will open our own stock shop. So the journey is going to be a bit long. Please stay with me so that you can learn bit by bit, and then you can be self-sustained on this one. So having said that, I will start with a very basic thing because there might be many people who may not know some of the things. I'll start with that basic here. So basically, Indian security market is governed by the SEBI, Security and Exchange Board of India. Under that, all the stocks and commodities, everything comes in, and then even the NSE and BSE, all the stock exchanges come into that one. Whatever stocks or the mutual funds, whatever we buy, everything will be a digital one. So we will also be governed by the NSDL and CDSL. So these are the two places where whatever you buy, it will create a digital contract and it will be placed there. And to do all these transactions, we will have to have stockbrokers. Previously, the stockbrokers were co-located, or placed within the exchanges. Now they are not much co-located, and everything has been digitalized right now. So you will find many brokers across India who can provide you that platform to work with that one, and even some of the banks are also giving nowadays. So basically what is required to do a stock transaction is, one is your bank account, you need a trading account and a demat account. Okay, so basically it's a 3-in-1 account. So whenever you approach any of the known banks like HDFC or ICICI Bank or Canara or SBI, so they will create a 3-in-1 bank nowadays. So to open a demat account, you need certain documents. Basically, one is the Aadhaar, a PAN card, and your bank statement. And here I have shown you some of the top brokers in India who can facilitate you for opening all the demat account. And uh, most of these brokers have the brokerage. So it varies from one company to another company, but overall it will be almost on the same. And how much transaction you do, it depends upon the brokerage, whatever they charge to you. Okay, I have my demat account in ICICI and Zerodha, so you can choose whatever platform you want wisely. And whenever by any chance, if any of the broker is bankrupt, you don't have to worry. Most of your documents or whatever securities that you will have, it will be placed either in the NSDL or the CDSL. NSE normally works with NSDL and BSE works with CDSL. And some of the banks, they try to go with NSDL or CDSL. Okay, so I have just given an example here about UTI, IDBI, and then LIC and HDFC for your convenience here. So going forward, what are the different types of investments that we have? That is more important that we need to identify, and also we need to bucketize that one. So here I have given a list of the different investments here. Like you have the real estate, bank fixed amount, fixed deposit, post office, mutual funds, PPF, and so on. Okay, so whenever you try to invest in any of the things, first you need to identify whether what is the risk amount that you can take, or are you looking for a guaranteed amount, or you can look at a non-guaranteed amount. If you look at the right side here on the flow chart, so fixed deposits or the post office investments, PPF, all these are the guaranteed amount. They would say that you would get a certain percentage of guaranteed amount for a fixed amount that you will place in their account. And non-guaranteed amounts would be like your equity or the gold investments or the ULIP or real estate. Okay, where we don't know what would be the return that would be getting, because that would be depending upon the stock market and the geopolitical reasons, and also the company performance, government performance. Many things are there in that one. Okay, so I would say that once you fill your guaranteed investment bucket, then only you move to a non-guaranteed. Unless until you don't feel that, don't straight away get into the non-guaranteed ones. Okay, here I'm just giving an example of one of the bank here, Repco Bank. It is more prominently located in the southern India. They have two different types of accounts, or the deposit accounts here. One is Tanga Magal and then Ambu Magan. Okay, both of these are for the young kids, young boys and girls. You can keep in their name. This they are giving a rate of interest of 7.75, and any girl child, uh, even less than 18 years also, you can put the money with the 8% return. The more interesting part here is, if you look at the stakeholders here, uh, shareholders of this bank, most of them are the governments, state governments, and you can see the percentage that they hold in this government. This is the reason I'm trying to say that this would be a safe bank for depositing your amount, whatever you would take. Okay, and then the other safest one would be the post office. Here I'm giving an example how you can utilize the term deposit in a post office here. Okay, uh, normally what people do is, whenever they have an excess amount of money, they will create a term deposit, maybe once or twice, and then they leave it. But if you make it a disciplined way, you can get a regular income. Okay, I'll try to explain this example here. Okay, let's think that you will have a surplus amount in the first year in January. Okay, you will create a term deposit for 1.5 lakhs, and in May and then September. So whatever amount you have deposited, you will get a return for that in the next year on the same month. That means if we consider 7% here, we are getting 10.5, 10,500 as a return here. And this term deposit, I'm taking an example for 5 years. So that means you will get your interest every year on the same month, and then at the last, once it matures, you will get your principal amount. So the next year, what you have to do is you have to invest on the next months, February, June, and October, consecutively on March, July, and November. Okay, so if you do practice this, by fourth year you would have completed investment for all the months, and fifth year you will get a return every month. So this will be like before your pension, you are trying to make your own pension on your own. Okay, if but only thing is, this should be a disciplined way of investing, then only you can get this pension like amount on a monthly basis. Going forward, I'm trying to give an example of what is a primary market and a secondary market here. Let's think of a company which is a private company, okay, and they want to expand uh, their business into different areas and different geographies. Then they would need certain capital. So at that time, what they will do is they will try to create securities, and then they will offer a public offering. So that is what is called as a initial public offering, IPO. You would have heard this and you would have seen this in the newspaper. Some of the articles would come on this one. Okay, so at that time, when you have excess amount, you can place an order in your demat account for that company, and then if you are selected in that one, because the number of shares and the number of people applying for that may be more, so then they will pick on a lottery basis, and then they will provide the shares amount, whatever the amount that they have asked for. Basically, in an IPO, you have to invest minimum of 15,000. That's the basic lot that you have to invest. So that is where the primary market comes into picture. The secondary market is like once you have shares, you can sell it to another person who is interested in buying that one at a higher price or a lower price, whatever it is. So in the secondary market, the the shares will be transferred from one person to another person, and company will hold certain percentage of the shares there. Probably they hold around 70 or 75%. Rest of the 30% they will give it to the public. Okay. So here are the different types of primary market public issues. So it can be a public issue under that IPO. That's what I explained in the previous slide. Either it can be a fresh issue, a first time issue, or offer for sale, and it can be a FPO also. Once the IPO has come, if they want to give additional shares, then they can give it a FPO. And then they will also provide rights issues. That means if somebody has a certain amount of shares, the company can consider that they can give additional shares to that one in terms of right issues or bonus issues. And these private placements are for the HNI and other large scale investors or the angel investors. So in the secondary market, we have two main categories. One is the equities and the other one is the derivatives. So in the upcoming videos, I'll be speaking more about the equity and the stock, sovereign gold bonds, and exchange rate funds. I will not be discussing on the derivatives because this requires the more number of capital and it has high risk in any of the market. Okay, and unless until you understand this equity market, there is no meaning in getting into a derivative market here. Normally, nowadays, what I have seen is the moment you open a demat account, people jump into the derivative. They they lose a lot of money in this one, and then they will move out of the stock market directly. So even if you see some of the uh, information provided by the SEBI, 90% of the people they lose money in the derivatives. So when you say lose money means the amount whatever you have invested in the derivatives, that will go to always the large pockets. That's why it is better not to get into the derivatives in the initial stages. Okay, so having said that, I will close this video at this point here. If you have any other questions or queries, you can uh, mail me or you can contact me on this number. Thank you.